And hello once again, options traders. Well, it looks like we're in for, at least so far, a little bit of a bounce off the opening bell here. I'm talking, of course, on February 26th of 2020. And so it looks like hopefully this coronavirus scare is behind us. But just a few days ago, I posted a video entitled, "Why Are There So Many SPY Expirations?" And in that video, I showed that if you're using the SPY, the ETFs, versus the SPX, the actual index, that you could get different choices. Under the index, the SPX, you might actually see AM and PM settlements. So not only do options have different expiration days, but they can have different expiration times. And this really throws a curveball to new traders, and rightfully so. You can end up with some very unwanted surprises if you don't understand these. So let's take a closer look at AM versus PM settlements. So let's just start with some basics with options settlements. We all know that options expire on particular days, but they can also expire at different times. And this is when we get into what are called AM versus PM settled options. Now, to make it easy, all of your equity options, that is stock options, are PM settled. And if they're ETFs, remember they trade like a stock, so they're also PM settled. Those are the easiest to understand. But if you're trading the indexes, they might be either. They can fall into one of two categories here, and this is where you have to be careful. So let's start with the easiest, again, the PM settled. This is probably what you're most used to. So if you're dealing with a PM settled option, and again, that's definitely going to be any of your stock or ETFs that you're probably most familiar with trading. Remember that your last day to buy, sell, or exercise is the Friday at the close. So if you have a weekly option, a Friday weekly, it would be on that Friday at the close. If you have an index that maybe expires on Wednesday, it would be the Wednesday at that close. But it's always through that trading day. You have that full trading day to buy, sell, exercise. So for example, let's say that we have the SPY $320 call. Now the SPY again is an ETF, so it's going to trade like a stock. So let's say that the SPY closes at, I'm just going to make up a kind of a random number here, 323.68 on expiration Friday. So we're going into the closing bell. The index here is at 323.68. Well, what do we know? We know your 320 call is worth $3.68, just that intrinsic value. Now, of course, to capture that, you would have to actually sell it. If you exercise it, you'll end up with a 368 unrealized capital gain. But the point is, we know exactly what that option is worth because it's based on the closing price on that Friday. However, if we have an AM settled option, we can run into all kinds of complications. So for example, let's take a look at an AM settled option. So remember, most of your indexes are AM settled. Probably the most notable exception is the OEX, or the S&P 100. That's actually an American style, and it is PM settled. Now, most of your AM settled options, your indexes, are going to be European style, which means they can be exercised only at expiration, and they will be cash settled. Why? Because you can't actually deliver an index. It's just a number. It's not an ETF, it's just a number. And so if you want to trade the actual index, they are just going to settle in cash. But if it's an AM settled index, they expire on Friday morning. That's why it's called an AM settlement. Now, some traders like to think of these options as expiring on Thursday and that they just settle on Friday, and that's okay. You can think of it that way. But the reason it's called an AM settled option is it actually expires on Friday morning. A traditional PM option would give you the full day through Friday to trade it. You can't do it with an AM settled option. You can't do anything on Friday. This is just when we're going to make the settlement values, and this is where it gets tricky. So remember, if you're trading an AM settled option that expires on a Friday morning like this, your last day to buy, sell, or exercise is Thursday at the close. So again, you can think of it as though these options expire on Thursday, but technically they really expire on Friday morning. But the last day that you can do anything with them is the day before at that close. Now here's where it gets even trickier. That closing price that you see on Thursday, a lot of new traders say, hey, this is the price that I'm going to get. This is what my call is going to be worth. Is this intrinsic value, for example? Well, the AM settled contracts don't work that way. Instead, there's what's called a settlement price that will be determined on Friday morning. And that's what determines how much value your option has. And to make it even more complicated, the opening price that you see on Friday morning isn't the same thing as the settlement price. This is the big kicker. That's why I've put it here in red. This is what catches people by surprise. They say, well, I see that the index opened at such and such a price on Friday morning, and therefore my call option should be worth this. Or it closed at this on Thursday, and therefore my option should be worth this amount. Neither of those have anything to do with what that option is going to be worth. So to see the complications, let's take a look at an AM example. Now we just looked at a 320 call for the SPY. It's a 1/10th index. So let's say we're trading the actual index, the SPX. The corresponding call would be the 3200. So you might be thinking, well, it's 6 of one, half dozen of another. I can trade the 320 SPY or the 3200 SPX. So instead you buy this SPX and we find that it closes at 3203.68 on expiration Thursday. So just like with that 320 call, you're thinking, well, my $3,200 call is $3.68 in the money. So therefore, I'm going to get $368 cash tomorrow on Friday. This is the closing price. I can see there's $3.68 of intrinsic value. And you're going to find out that there's not. And here's what can happen. Let's say that your stocks are down in the morning on Friday. The thing you have to understand is that only the opening prices matter. And further, all of the stocks in the index must be open. And to make it even more confusing, it's actually determined by an administrator. And so there's all these rules for saying, well, if a stock didn't open, we're going to use the previous closing price. If that day was a holiday, we're going to use this. They have all of these rules for how we're going to determine this settlement price. So this is what most traders don't understand when they're trading the indexes. If you're trading the SPX, you have to look at what's called the settlement price, which just like a ticker, you can bring it up in a platform under SET. That's what's determining how much that option is worth. For the NDX, the NASDAQ 100, the settlement value is NDS. For the Dow Jones, DJX, settlement is DJS. For the Russell 2000, RUT, the settlement is RLS. And for the VIX, the settlement is VRO. But this is a whole nother video in itself. The VIX actually expires on Wednesday. So we're going to kind of put that one to the side for right now. But these are what are called the settlement prices. And it's kind of an official way to determine what was the opening value of this index once all of the stocks were trading. So here's where you can get caught. So let's say that this is our index here. Here's the S&P, and we get this nice candle here at the close. And this was the 3203.68 level that I talked about. This is on Thursday. So again, some traders would think that this option is going to be worth, this $3,200 call is going to be worth that difference. Not true. But then they say, well, now if we understand that it's based on the opening price for tomorrow on Friday, here we come into Friday and we see the stocks might be down a little bit. And we say, oh, it's trading at 3203, not too bad. But what they don't realize is at this point, not all of the stocks are open yet. And so it could be several minutes that it just appears to be trading sideways. The actual opening that you see on your platform of the SPX might be 3203. But again, all of those stocks aren't open. So maybe during the day, we actually see it do this once all the stocks are open, and then maybe it even rebounds. And we see it coming back up this way. And so what traders do is they say, well, here was the opening price. Not true. Down in here is going to be the opening price, or wherever it was when all of the stocks were open. And so you might find that the settlement price on Friday is, 31.80 or something. It could be a whole lot worse. You're going, wait a minute, this is, people scream foul, this is conspiracy. It closed at 3203. And then back here it opened just a little bit down, and now they're telling me the official settlement price is way down here. That's exactly right, because you have to wait for all of the stocks to open. So you end up with kind of this little wild card area, this delay between Thursday night versus the official open or the settlement values on Friday. Let's pull up a TOS platform and see just how big these discrepancies can be. And this is a perfect time for it because of the recent down days we've had because of the coronavirus scare. But if we pull up a calendar, let's say we're trading the SPX, the actual index. We can see on the calendar for February that would have been the third Friday right here on the 21st. But it expires in the morning. So your last trading day would have been the 20th. So again, if you're new, you might be looking on the 20th and thinking this is what's going to determine your options value. So let's go over to the 20th, and that's this candle right here. And so if we look at the closing price in TOS up here on the left, you'll see that the closing price was 3373.23. So again, this is where traders would say, oh, this is what is going to determine my options intrinsic value. So if I have the $3,300 call, it's $73 and change in the money. And we're going to find out it's just not, because it's on this day right here that we're going to determine that. However, what was the opening trade? Look over here. Was 3360.5. And again, that's not even going to be the official open. We have to look at the settlement price, which is found by SET. So let's go over to the CBOE's website and take a look at what it was for this date. All right, so now we're on the CBOE's website, and you can find it from CBOE data, historical options data. If you have a hard time finding it, you can just go to the search feature and type in index settlement values. And what you want to do is look right here for the index settlement values. Now, if you're looking at weeklies, remember they expire on Friday. That's just going to be the standard closing price. If you're looking at end of month contracts, you'll need to look here. Quarterly settlements will be here, but the standard index is going to be here. So let's pull these up for 2020. And right here, S&P 500, as determined by the settlement value, is actually 3357.19. So if you remember, the closing price on Thursday was 3373 something, so this is about 16 points lower. And if we looked at the opening price, according to Friday morning, it was 3360, but we're even below that. Why? Because when you saw that print at 3360, all of the stocks weren't open yet. So again, traders end up thinking that their options that are in the money are now out of the money. Now, of course, we could end up with a pleasant surprise, but the main thing that you want to take away from this is that if you're trading AM settled indexes, it's best to close them on Thursday. And that way, what you see is what you get. You know exactly what you're dealing with. You're not having to wait for the Friday settlement price to be determined. You're not taking the risk that bad news might come out. Now, of course, there is another strategy we can use, in that if it appears to be worthless, this option you're holding, well, rather than closing it out for nothing, you might take the gamble and hope that the settlement price gaps way up and actually gives it some intrinsic value. But for the most part, I would always try to close these on Thursday. So again, as a reminder, what I talked about in that previous video there, if you are trading the SPY, this is the ETF, it's going to trade like a stock. And therefore, all of your expirations, it doesn't matter which one you're looking at, is going to be PM settled. And another way you can tell that is by the SPY ticker here for these symbols. But if you're trading the SPX, let's go do SPX. This is the actual index. And we might get AM or PM. Now, what makes it even more confusing is that the index itself, the SPX, has these weeklies and extended weeklies and things that I talked about, which you can tell from this ticker symbol, SPXW. These used to be SPXPM for evening settlements, but they changed that, I think in 2017. They're now SPXW for weeklies. But if they have an SPXW, it is a PM settlement. But if you happen to be trading the quarterly contract, or somehow just accidentally click on this one without understanding it, notice that you don't have SPXW, you have SPX. And this is going to be an AM settled. Now in the E-Trade platform, they give you an added notation up here to remind you this is an AM settled contract. So one of the main reasons they did this was to align with the futures contract so that the settlements would be more in line. But the biggest point is that especially if you're new and you decide to trade the SPX, I would probably advise to avoid the AM settlements. So I hope that clears it up and hopefully keeps you away from some unwanted surprises. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.